Hi everyone, this is Konrad Bobilak, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple, and welcome to this very short video that I've made, first video of 2017, where I'm going to give you a bit of an idea of where we currently are in the property market in terms of the property cycles, and also where I think the market's going to be heading in the future. So I must stress before I get into property cycles and capital growth and different suburbs, as a property investor, I would never really focus on short-term capital gain of anything. You know, when you're investing in property, the key thing is always that you're investing for a period of time of, let's say 5 to 10 years. So if you try to, guess the market or pick the, part of the cycle that we're currently in, it's a form of gambling almost. So to me, it's really not that important what the market's going to do in Melbourne in the next 12 months. Having said that, obviously this video is exactly about that. Where are we heading? Where have we been? What's likely to happen in the future? Also, what I want to do as just a bonus for you guys with no strings attached is, if you watch the video to the very end, I want to give you a link to a 10-hour online home study, which is called the Real Estate Investing Fast Track Weekend, which is a recording from 2 years ago. It's very current still because predominantly it's on finance, and really there's nothing really changed in finance in the last 2 years. And it really teaches you how to build and structure a large property portfolio correctly from scratch and replace your income. So stay tuned to the very end, and I'll give you a link so you can upload and watch this home study. Plus there's a PDF document containing all the PowerPoint slides, so you get a manual as well as the home study. Worth $497, free for you guys. Let's talk about 2016 before we talk about 2017. A very interesting year. In fact, most people got it completely wrong. In fact, economists predicted that house prices would stabilise in 2016, but in fact the opposite happened. And before we get into where the market's heading, I just want to give you a bit of a history and a bit of a background about all the failed predictions of the so-called academic experts who come out every year, talking about what the market's going to be heading and where it's going. The interesting thing about it is that if you're even slightly remotely positive, and if you're talking up the property market in Australia, you're almost seen as a naive person. It seems to me that in terms of the academic world, the best thing to do is be always conservative. So even if the market is going at 12-15%, the academics will say, yes, but how long is it sustainable? And it's got to change next year. It's almost like you have to be a pessimist to be an academic, because if you even show the slightest optimism about the property market, you're almost like a gambler, or you're almost like a naive person, which is what we've seen time and time again. The market had very strong indicators for the last 3 to 5 years, yet most people were predicting the market was going to correct, and in some example, the market was going to crash. And this is what we've been hearing a lot for the last 3 or 5 years, especially in the media. The market's going to crash, the bubble's going to burst, Melbourne property market is going to crash, and obviously it hasn't happened. We've seen very strong continuous growth. I wouldn't say the market has boomed in Melbourne, I'll just say it's very strong growth compared to the boom we had in 2001, 2002. It's a very different environment that we're currently in. Every time I hear the property bubble's about to burst, I feel like Stephen Wright. I'm experiencing amnesia and deja vu at the same time, because I've been hearing this stuff for the last 15 years. And in fact, I keep waiting for this mythical bubble to burst in the property market, and it hasn't happened yet. I hope it's going to happen, because I really want to go down to Brighton, to the Golden Mile, and I want those rich people running out of those big mansions that are worth about $16 million, because my definition of a property bubble bursting always means I could pick them up for maybe $100,000 or $200,000, right? So they'll be phenomenal. I don't even care about the capital growth, I just want to live there. So let's talk about the housing market and how many people got it horribly wrong in 2016. And this is the interesting thing, people get it wrong and no one talks about it. And the cool thing is that I've been collecting this information now for 10 years. I've been carefully documenting all the prophecies, all the failed predictions of key academics and so-called experts, both in Australia and internationally. And I've been putting them in a book, and I've been putting them into a PowerPoint presentation that I show a lot of my investors. This guy came out last year from the US, and it was very interesting because Jonathan Tepper is the kind of guy that says, just like in the movie The Big Short, well, the market's going to crash, and I know you can be skeptical, I'm going to be right at the end. The market's going to crash. You're going to lose all your money, just like in the UK, and just like it happened in Canada, and just like it happened in Ireland. And of course, he shorted the market. And in February 2016, he predicted the property market would drop by 50% in Australia. It's going to be a bloodbath, apparently. Just to put that into perspective, the median price in Melbourne today is $770,000. That means that the median price in Melbourne for the average house would drop down to about $375,000, which is obviously impossible and it won't happen. This is another so-called expert. He's a microeconomic researcher. I remember when I did my stats at Monash University, we used to have a saying, there are lies, there are damn lies, and there are statistics. And he predicted there's going to be a bloodbath as well in 2014, and the whole market was going to crash in Australia because of affordability issues, and it's going to be the same story is going to play out as it played out in Ireland and America. And of course, nothing happened. This is my favourite person out of all of them. He comes out of the woodwork every 5 years with a new book prophesizing doom and gloom and Armageddon. And of course, he tours around the world, talks about how everyone's going to lose money, but more importantly, how you can protect yourself, and the secrets are all in his book. And he tells you exactly where to invest when everyone's losing money. And of course, he gets it wrong. The tour finishes, he sells a bunch of books, goes back to the US, and nothing happens, which is exactly what happened last time he was here, talking about how in 2014, we're going to lose, our prices are going to crash at least 27% in Melbourne and Sydney over the next several years. Very kind of a vague, several years. This is actually a local guy, is academic and economist Stephen King from New South Wales. Now, he's been predicting the property market was going to crash by 40% since 2008. It's 2017 right now, so 9 years later, it still hasn't happened. And he made a bet with one of his friends at Macquarie saying, the property market's going to crash. And of course, his friend at Macquarie said, no, it's not. I'll make a bet with you that it's not. And obviously he lost. The irony of these people is that when you get to a point in time, whether you're an economist or you're a research specialist or an academic, the moment you put down in print that the market's going to crash over and over, and especially if you write a book about it, you can't really go back on your word. So people are kind of expecting these guys to say, you know what, stuff it. After 15 years of being completely wrong, I admit all my technical analysis was wrong. The market's not going to crash because I don't really understand the property market in Australia. And I'm sorry, I got it wrong. I've got to retire now and I'll keep my mouth shut. I mean, ideally that's all happen, right? Of course it's not going to happen. What do you think these guys are going to be doing for the next 20 years? For the next 20 years, the only thing they can do is to say, well, it hasn't happened yet, but it's going to happen. You just wait, and you be sorry. You just wait, and they'll be saying that for the next decade or two. Meanwhile, investors are snapping up bargains, and that's the key thing. So one of the key things about being successful in property is you've got to really identify the people that you want to listen to and the people that you don't want to listen to. And for me, it's a very simplistic principle. Number one, the Australian property market is not an investment market. 72% of houses in Australia are unoccupied. It's not an investment market. It's not a market driven by fear and greed and speculation. Number two, 70% of investors, who represent a small fraction of the market, only have one investment property. They're not really investors, are they? They just one day woke up, got the paper from the milk bar, saw an auction, they bought a property around the corner from where they live, possibly, and most probably, very comparable to what they live in, and they call themselves a property investor. Less than 0.8% of investors in Australia have more than 6 properties, which is kind of a definition, a benchmark, a minimum benchmark, I guess, for being a property investor. So the key thing is, why these guys get it wrong all the time, is because they assume they're dealing with an investment market. It's not an investment market. It's not even, housing is not even deemed an asset class under the Financial Services Act. People live in houses for emotional reasons. That's why they live there, not for economic gain. And that's one of the things that these guys keep missing out on when they do their technical analysis. Let's have a look at what actually happened in Australia in terms of 2016. If you look at Darwin, Canberra and Hobart, you've got the growth there for units and houses and combined homes. But more importantly, if we jump over to Melbourne and Sydney, you can see Sydney did 16.74% for houses and 15.46% combined for homes. Melbourne, another thing, 15.8% for houses, 13.68 for homes. Apartments, 1.74%. We've got a massive oversupply of apartments in Melbourne, especially in Docklands, South Bank, South Yarra, South Melbourne, places like that. So our apartments are definitely going to show very low growth. Sydney apartments are actually doing quite well. People make really good money in apartments in Sydney. Melbourne apartments don't do so well. There's in fact only about 12 suburbs in Melbourne out of 390 suburbs that I think are worthy enough of investing in apartments where you're going to get okay growth. Not even spectacular growth, just okay growth. But it's interesting how wrong they got it. And you know, the argument is always, well, it's just unsustainable, isn't it? You know, what a broad argument. It's unsustainable. People just can't afford to buy a $3 million home. The thing about it is, and this report comes out every couple of years talking about, this is from a US-based consultancy firm called Demographia, and they talk about the fact that, well, Melbourne, for example, now, well, Sydney is still unaffordable. The average household income in Sydney is $88,000. The average median home is $1,077,000. Therefore, that's a 9.2 median multiple in 2012. Now it's a 12.2 multiple. Therefore, no one can get a mortgage to buy $1 million home. Can you imagine a more simplistic view and outlook on how the property market works? So these guys think that every year, the way to assess the property market is to work out, let's assume everyone starts from zero and gets a mortgage this year. Could they afford the average house? Why would that happen? Our real estate market in Australia is worth $6.5 trillion. Our gearing is around 40%. There's 60% in equity in our property market currently. So when people go and buy a house in Toorak for $6 million in Melbourne, they don't go, oh, hello, Mr. Banker, I'd like to buy this $6 million house in Irving Street in Toorak. I've got my first home buyer's grant, which is $16,500. So I only need another, what's that, $5,900,000. Is that how it works? Of course it's not. Suburbs that are $3 million currently have people waiting next door in suburbs that are worth $2 million with equity they're going to roll over into those suburbs. The reality is most people virtually never borrow more than $1 million for owner-occupied lending. I know that because I used to work for a bank and had a mortgage broking company. So the challenge of this argument is, you know, for Melbourne, for example, the average household income in Melbourne currently is $78,000. The average median price, or the median price of the average house is $740. Divide that by that, you get 9.5. It's unsustainable. Compared to what? It's unsustainable if that person's going for a brand new mortgage. The equity locked up in the housing market is never leaving the housing market in Australia because it's capital gain tax exempt. When you sell the house you live in, you don't pay tax on your profits. Therefore, that equity that's locked up in our $6.5 trillion market is never leaving the market. Number one. Number two, we have an extremely fragmented market. Our suburbs are very different from each other. We have suburbs where people live, we have aspirational suburbs, we have poor suburbs, we have wealthy suburbs. There is no correlation between a lot of suburbs. Melbourne now is so fragmented, we've got 8 distinctive markets. You know, the other thing is that in Australia, ownership of homes is heavily entrenched in our culture and our value system. It almost becomes part of our identity, far beyond the brick and mortar of the property that we live in. We actually identify ourselves based on the suburb that we live in, which is a bit bizarre. In Europe, that doesn't happen. You know, in Germany, 95% of people rent. No one cares about ownership. But in Australia, we've been conditioned to have homes. You know, it's almost our rite of passage. So during a recession, for example, people will sell cars, they'll cut back on holidays, do everything they can to keep the house. And that's the reality that you can't model based on technical analysis, which is what these guys keep doing. So the reality is just having a simple argument that household income doesn't cover your average mortgage, who cares? It's you know, based on this argument, no one should be driving an S500 Mercedes-Benz for $498,000. You could do a mathematic modelling saying you could buy a Statesman for $90,000. Why would anyone buy a $500,000 Mercedes-Benz? Why would people pay $2,000 for a Louis Vuitton bag? Because they can and they want to, and they want to be seen with that bag in that car. And that's what in Australia people do. They aspire to live in certain areas and they'll pay a premium, go into debt and do whatever it takes to get there. And that you cannot model based on technical analysis, and that's why these guys get it wrong. These guys always assume we're dealing with an investment market, a market that's based on fear, greed, speculation, but underwritten by logic and people selling properties if they drop in value. If your house in Australia devalues tomorrow by $100,000, are you going to run out of your property and sell it because you lost $100,000? Of course not. You know, would you do it with shares? Absolutely. Because you can't live in your shares, you can only live in your house. It's part of your identity. That's what they keep missing out on. Academics have been predicting the property market was going to crash since the 1960s, and that's one of the issues. So let me just show you all the failed predictions of these so-called experts since the 1960s. In 1960, we had emerged from a major credit squeeze, finance dried up, property prices were going to crash. In the late 60s, we had nickel share boom, and the property was proclaimed an inferior investment. Once again, the property market was going to crash. In the 1970s, we had a recession, high unemployment, possibly high interest rates. Once again, the market's going to crash. In the late 70s, we had rising inflation and the OPEC oil crisis. Once again, the property market was inevitably going to crash. In 1983, there was a recession with high interest rates, high inflation as well. You know, interest rates were on the way up. People were concerned, market's going to crash. In the mid-80s, commentators were saying that property prices were too high in Australia. They're unsustainable. In 85, we had the introduction of capital gain tax. So-called experts said, well, now, because you're going to get taxed for your profits that you're making from buying and selling investment properties, this is the end of the property market as we know it. Of course, 85 was one of the best times to buy real estate in Melbourne. In 87, we had the stock market crash of 87. Once again, we had technically a depression in the US. And once again, you know, people were very concerned about the property market in Australia. And once again, so-called academics were predicting the market was going to crash. In 1989, 1990, and 91, by the way, interest rates got up to about 21%, which is, I don't even understand how you can do anything at 21% environment. It's almost mafia money. We had the famous recession we had to have. And people were saying property prices will never go up any higher. Don't invest in property. We've hit the ceiling of property prices in 1990. You could have picked up a nice house in Middle Park in Melbourne for about $90,000. In 91, we had the record high unemployment again, 11.3%, and once again the sentiment was property prices will never go up in value again. In 93, 94, we had record high foreign debt and current account deficit, deterring a lot of people from entering the property market. In the 90s, we had the world economic slowdown, the Asian currency crisis. I was at Monash University studying how wonderful Japan was with people working for the next 50, 60 years with guaranteed jobs. TQM, Edward Deming, all out the window, all gone. It's all theory now. It's footnotes in the history of failed economies. In the mid-90s, we had high inflation, and a lot of people felt that once again, property was an inferior investment. Then we had September 11, oversupply of investment properties. We had a lot of uncertainty in the property market. Then we had the subprime fallout in the economy. You know, we had the American market collapse. And yes, it took down some companies in Australia. There was definitely fallout. The sentiment was record low in terms of negativity. People were just very negative out there. There was a lot of uncertainty, and people with the lack of knowledge lost money on property. Then we had rising unemployment, recession. 2011, we had, you know, now the argument has been fine. You know what? It hasn't crashed, but it's just unsustainable. It has to crash eventually. The key thing is, wealth is always transferred from the uneducated to the educated. And during these periods of time, I know developers and property investors that have made an absolute killing. You know, they bought more property during the bottom of the market than any other time. During recessions and depression, there is more transfer of wealth that occurs than any other time in the economy. But the key thing is, you've got to have the right level of awareness to take advantage of the prevailing circumstances. There's no point you going in during a recession and try to learn about the property market or what to buy. Because you're going to be, you won't be able to filter all the white noise. There's going to be so many negative people talking about Armageddon and the sky falling, you won't be able to get to the truth of the matter. The best time to learn is when the market's actually doing well or going sideways, and then the time to act is at the bottom. And that's the reality. 2017, well, it just can't go on forever, can it? There has to be a correction somewhere. Well, let me show you an article from 1949 that you can read at your own leisure. Where are we heading? The housing cost spiral. The expression is often heard, this can't go on. It conveys the widely held opinion the home building costs are beyond the capacity of the average home purchaser, and the increase of roughly 209% since pre-war means that the home sold for £1,000 in 1939 now cost around £3,100. And of course, working out the average income, that's unsustainable. And therefore, in 1949, we have reached the actual pinnacle point of housing prices in Australia, being £3,100 or around $7,000 Australian in today's terms. And of course, that's, this is the thing. So people have been talking about this income versus house price, equilibrium, I guess, that's been out of whack for since the Second World War. Nothing's changed. You've got to understand. Every generation, there's going to be people locked out of the property market. Every generation, there's going to be people talking about how our kids can't get into the property market. Of course, they can get into the property market. There's 390 suburbs in Melbourne. You can still get into around 30 suburbs under 500,000. Yes, you can't buy anything in Hawthorn for 500,000 on the river. I'm sorry about that. You're going to have to compromise where you live. Not everyone can live in the city or just outside the city of Melbourne, which is the most livable city in the world. You're going to have to do some compromising on the type of property you're living in or the area that you live in. That's the reality, So I don't buy into this BS about properties being unaffordable. They're unaffordable in certain areas. But that's like saying, I want to drive a brand new Bentley. It's $1 million. Can't I get it for 40 grand? I've only got a 40 grand budget. Why is a Bentley $1 million? I really want one. Well, tough. That's the reality. Life sucks. Wear a helmet. During the GFC, I was talking at different events, and ironically, at one of the events, Harry Dent was talking about how the market's going to crash in Australia, and I was telling people in 2008, guys, this is the best time to buy because everything was undervalued. Now, I know developers in Melbourne, investors, that made an absolute killing in 2008. They were buying properties way below intrinsic value. They're paying wholesale prices in a retail market, which really doesn't occur. Meanwhile, so-called American experts were saying that our market's going to crash during the GFC, and it's just a matter of time. It could be a year or two, but it's going to happen. 2008, it's nearly 10 years later, guys. It hasn't happened. If they had any balls, they'd just come out and say, you know what, we stuffed up, we got it wrong. We're going to retire now, we're going to take up another hobby. I don't know, maybe things like becoming a personal trainer or, installing speakers at JB Hi-Fi. Maybe do a career change. Maybe predicting property prices in the market's not your thing. The median prices in Melbourne, 1966 were $13,000. Now you got to understand something. Property in Melbourne was always extremely expensive and unaffordable. Relative to income and earnings, that was in fact the same as 700,000 today. People argue yes, but the coverage of average annual income was different. It doesn't make a difference, it's relative. It was always unaffordable. People always struggled to get into the property market. Nothing's changed and nothing's going to change. 1976, 37,000. 1986, 83,700. 1996, 144,000. 2008, 432,500. 2014, 607,000, today 770, depending on which week you look at. So what can we discern from that? Well, property prices tend to double every 7 to 10 years. Not in all areas, but that's a general thing. The thing about it is you got to look back and you got to kind of take yourself out of the human equation and look what the herd mentality does. And what you got to do if you want to win this game is do the exact polar opposite of what everyone's doing. Because what everyone does, and we know we end up, majority of Australians end up dead broke at 65. Cash flow poor, okay, with no income. I mean, the average super fund balance now is something like 150,000 for the average male retiring at 65. They end up with one house paid off, a lot of equity, but no ability to access the equity, and no cash flow equals no lifestyle. And the thing about it is, guys, people are not dropping dead at 65 anymore. Like in the 60s, you retired from your job, a year later you found dead on your veranda, kind of a thing. Now, these guys are going to gyms, they're drinking green drinks, NutriBullets, they're supplementing, they're going hard. People are living 30 years after they retire. So think about that. What are you going to be living on for those years? You've got to prepare now. And this is what happens in the market. When the market's going strong, everyone's getting in, especially at the very top, which is kind of where we are at the moment. We're about 11 o'clock on the property clock in Melbourne. And then what happens is there's a correction, which happened in Sydney. From 2008, there was no growth for like 5 years, and then suddenly everything just went up overnight. The best time to buy really is at the bottom of the market, where there's complete panic and despair, and people are just dumping properties. This is where you can negotiate better terms of settlement, vendor discounting, delay settlement. This is where the money is. When the market's heated up, it's the worst time to buy. It is a good time though to lock in your higher valuations, and that's a good thing. So be fearful when others are be greedy when others be fearful when others are greedy when others are fearful. Warren Buffett. So if you look at the median, this is from the Sydney property market, which is probably the most important market we have in Australia. These are headlines from the Sydney Herald Sun, plotted against the actual capital gain movement of the median price movement in the Sydney property market. September 93, Sydney wins the Olympics, property prices unlikely to rise. August 99, interest rate rise for concern, experts predict 20% drop in property prices. February 2002, has the property bubble burst? Possibly wrong time to invest, good time to sell. September 2002, property bubble about to burst. January 2003, is there a bubble? September 2003, property bubble will damage the economy. Now, do you see how this line goes like that, like a little bump? If you look at the Sydney property market since 1901, that little bump in the road is this little peak here. So let me put it to you this way. I advocate buy and hold, never sell strategy. Okay? And just never sell properties, accumulate the best properties you can in trusts through separate lenders and hold them indefinitely and never cross-collateralize them. With risk management in place, with cash buffer. If your strategy is buy and hold, never sell, how can you lose money on property? Well, you can lose money on property if you go out of your way to lose money on property, or if you don't have the right level of awareness and you buy in the wrong area and the wrong structure. So let me be clear, people are going to lose money on property from now to the end of time. People are always going to lose money on everything. Every year people lose money on shares, businesses are going to go bankrupt, people are going to lose money. The difference is the level of awareness a person has, and that comes down to you. The more awareness you have and the more awareness you cultivate in investing, the lower the risk. See, I don't believe there is market risk. In fact, I personally believe there is zero market risk. The risk is you. You're the risk. You're the one creating the risk. Property doesn't lose value. The human being loses value when they sell and buy at the wrong time, or buy and sell at the wrong time. Property never loses value. If you buy a property and you hold it 50 years, I guarantee you, in the worst areas, as long as it's got a land component, it's going to go up in value because there's a scarcity component and intrinsic value. It's the human being that loses money, not property. Here's the top 10 most affordable and most expensive suburbs in Melbourne. This is from 97, from the first edition of the Australian Property Investor magazine. Toorak, 850,000. This is for detached houses, guys. Brighton, 501,000. You can't even get a one-bedroom apartment in Brighton now for 501,000. We're talking about houses here. Malvern, 440. Armadale, 407,500. The poor bastards in Kew, 385,000 for a detached house. Camberwell, 370,500. Malvern East, 356,250. South Yarra, 350. Glen Iris, 330. Balwyn, 325,250 for a block of land with a house on it. Most affordable, Melton, 87,000. Noble Park, 96,500. Sunshine, 100,000. Glenroy, 102,500. St Albans, be careful there, 103,000. Sunbury, 104,000. Dandenong, 104,750. Frankston, 105,500. Mount Evelyn, 107,000, and Boronia, 107,000. If I was to ask you to print off the top 10 suburbs today in Melbourne in terms of least affordability and most affordable, guess which ones they are? It's the same areas. So what's really changed? Nothing. So why do so-called academic experts keep getting it wrong? I'll tell you why they keep getting it wrong. It's because they keep doing technical analysis rather than fundamental analysis. They keep looking at charts to predict what's going to happen. And what I do is I do technical analysis backed up by fundamental analysis. The X factor, the human emotion, the area, the walkability of the area, the lifestyle the area provides people, the prestige of the area, things that you can't necessarily represent mathematically in a very usable way. So what you're going to see is, my prediction is that many people are going to get their predictions wrong this year, and my prediction is that so-called academics experts are going to keep getting it wrong year after year, because they keep doing technical analysis and very little fundamental analysis. Do you know some of these guys, even in Australia, try to predict areas they've never been into? And this is the other part of the spectrum. I keep reading these hotspot reports from these different people, and I won't mention names. Some of them are quite clever, but I keep seeing these top 20 suburbs in Melbourne, and I keep seeing places like Melton, Sunbury, and I just go, have you been to Melton or Sunbury? Do you actually understand the area and the income per household and the makeup of the average household and the infinite supply that the area has in terms of developer stock? I mean, it's insanity. Some of these articles that are coming out predicting these hotspots of the future, they couldn't get it more wrong. And it's obvious to me these people that write these articles have never been to the area. They've never been in sales in real estate, and they're not investors. They don't actually know how to do proper due diligence. If you look at the Melbourne property market, it is extremely fragmented. This is from last week's auction results. And we've got 8 distinctive markets now in Melbourne without virtually any spillover effect between them. So it is changing for the first time. In the last 10 years, the Melbourne market, really nothing's changed, but what has changed is the wealthier suburbs are becoming more expensive and the cheaper suburbs are struggling to keep up. In fact, they're growing at a lower rate. So the difference between suburbs is becoming more profound. And it's now the suburbs in Melbourne, people are just completely priced out. I mean, there are 10 suburbs now in Melbourne. If you haven't got 2.5 million, don't bother looking. That's the reality. So how do you know where we are in the property cycle? Harrington White Valuers. This is the company that I recommend you follow. If you jump onto the website, you can download the monthly review letter, which gives you the property clock, which tells you exactly where we are currently in the property clock. And Melbourne, as you can see there, we're approaching the peak of the market. We've got another year or two of solid growth, then we're going to have a quiet period of time, which is great. I don't actually want the market to boom. I want the market to be sustainable and predictable and keep doing what it's been doing for the last 20 years. When the market is booming, people are irrational, and that's where you can't make money. You can't make money when people are acting irrationally. So I'm hoping the market's going to slow down because I want to do other things with my properties, and I can't do it right now because even now the market is going too strong. So Melbourne's at the peak of the market nearly, which is really cool. So a lot of opportunities still, but yes, in a few years you'll be paying top dollar for your properties. So if you buy at the peak of the market in a couple of years, and if you're waiting to buy, you're going to be very disappointed in terms of how much money you'll be spending to get into the property market. So which are the best areas to target in Melbourne based on long-term capital growth? If you look at Australian top national suburbs in all of Australia, Melbourne has the top 16 best performing capital growth suburbs in Australia. And you can see there we've got Mount Albert, we've got Balwyn North, Middle Park, Mount Albert North, Ashburton, Balwyn, Glen Waverley, Doncaster, Burwood, Mount Waverley, St Kilda West, Box Hill South, Dippendi, Canberra, Surrey Hills, Box Hill North. Where are all these located? In the eastern suburbs and the Bayside. These are the absolute best suburbs in capital growth without any kind of interstate suburbs. The same. It's basically the eastern suburbs, which is where the wealth is, the best schools, the highest income per household and scarcity of stock. There's no more land being created. So you have a lot of people with a lot of money, a lot of discretionary income, fighting for a limited amount of properties that are on the market. And of course the best schools are there as well, and the best restaurants. These are the worst properties and suburbs in Melbourne to invest in. Brookfield Melton, 2.5% growth per year for the last 10 years, which is below inflation. Officer, Cardinia, Red Hill South, Mornington Peninsula, Geelong, 3%. It's below inflation, Greenvale and Hume, Mornington Peninsula again, Wyndham's Landing. I keep talking about Williams Landing as people from Toorak are going to be selling up their mansions and going to Williams Landing. Williams Landing has been doing 3.2% on average for the last 10 years. It's below inflation. Now, it might be a good area to live in, okay, if that's your thing, but it's not a good area to invest in. And that's the key thing. You want to break down and separate the emotion out of the investment equation. So when you're investing, it's just pure for money. You live where you want to live. If you like the city, live in the city. If you like regional, go regional. If you like the beach, live on the beach. When you're investing, it's based on numbers and growth. You know, Point Cook, 3.5%. TOWNHOUSES, 3.7%, just barely keeping up with inflation. The biggest lie I keep hearing in real estate is population growth creates capital growth. No, it doesn't. Melton has the highest population growth virtually in Australia out of any area apart from Ipswich, and yet it has the lowest capital growth. Just because you've got a bunch of people with no money moving to an area and buying really cheap properties doesn't mean those properties will go up in value, because you have two things. You have low income per household combined with infinite supply of houses, which is a scenario in Melton. Melton, you can buy houses in every direction because there's infinite supply from developers. Definition of capital growth is low supply, or virtually scarcity of stock, but the most important thing is household income has to be high. And that doesn't happen in Melton. Now you might think, are you just putting the most expensive suburbs in the top 20? No, there's a lot of suburbs in Melbourne like Toorak that didn't make the top 20 because Toorak, which is now around $4 million, has an actual national average growth of 7.4%. You know, a lot of suburbs didn't make the top 20. Melbourne, Brighton, for example, you know, they're not growing at 10%, 11%, so they didn't make the top 20 cut. So if you look at Melbourne, my recommendation, irrespective of what I think the market's going to do, which I'm about to show you, is stick to the eastern suburbs and the Bayside. That's where the money is, that's where the growth is, because that's where you've got the highest income earners, scarcity of stock, best schools, best transport. Yes, you can make money anywhere. You can make money in Beaconsfield if you want to. You can make money in regional areas, because really the risk is always with you. But I'm saying if you're investing based on probability, they're the areas that are likely to give you the highest capital growth with no work from you. So just relying on the market. Now, I've developed the 42-point due diligence criteria as well to make things easier for people. If you ever attend any of my events, I actually go through the criteria in detail at the event, and I want to share some of them with you. The number one thing to look for growth, this is macro level analysis, by the way, so big picture stuff, is I look at the income demographic of the area. How much money are people making in the area and where they want to spend the money? If there's scarcity of stock combined with income per household that is above national average, you've got a good chance of making good capital growth in the area. The historical growth of the area, last 10 years, what has the area done? And also the future potential growth of the area. You know, Melbourne is priced based on the proximity to the city and the water. That's very important as well. Transport infrastructure, primary schools, the prestige of primary schools and secondary schools, very important in Melbourne. If you look at some of the best schools that are public schools, but you've got to be in the catchment area, like McKinnon and McKinnon High, you know, Glen Waverley. I mean, people pay a lot of money to be in the catchment area of those schools, and they are some of the best schools in Melbourne. So look at that as well. Obviously, vacancy rate, rental demand, that's a given. You know, future stock being offered by developers in the area. You know, there are suburbs in Melbourne, like South Yarra, completely oversaturated with future stock. Where if you look at Port Melbourne, Albert Park, there's virtually no stock coming on the market. So be aware of that as well. And housing strategy of the council. I like councils that are completely hostile towards developers. I love areas that have heritage protection, single dwelling covenant protection, height restrictions, all those things that stop stock being created, meaning scarcity of stock. That's the key thing. So what do I think is going to happen? I mean, we had RBA came out yesterday with no change in the actual bank swap rate. I think for Melbourne, if we have no change this year in the reserve rate, in the bank swap rate, I think we'll grow between 10 and 15%. I think we'll do 13% growth this year as Melbourne in terms of median price. And that means combining all the 390 suburbs together. If we have another cut mid-year, 0.25% cut or 25 basis points, I think we can grow between kind of 12 to 17%. And if we have another cut, or we have a rise, by 25%, 0.025 or 25 basis points, I think we can go down under 10%. I think if interest rates keep going up, not that they have, but if they do go up this year, and depending on what's going to happen in America and what's going to play out with unemployment and manufacturing sector in Victoria, I think we could actually have a slowdown in the property market. If I had to put my money, I think Melbourne's going to do 12 to 13%, and I think the RBA won't touch interest rates. I think it's just too dangerous. That's where I think it's going to happen. It'll be interesting to watch this YouTube video a year from now to see whether I was right or wrong. So, what type of properties to target in Melbourne? Forget about house and land, guys. House and land doesn't work in Melbourne. I've got access to 96 estates in Melbourne, and they're all bad. And I've showed you the growth of a lot of them, which are the most popular ones, like South Morang, Roxburgh Park, Point Cook. Townhouses are the way to go in the best possible suburbs you can afford to buy into. Apartments are also good, but only in a few suburbs. And if you're buying apartments in Melbourne, they don't really work in majority of the suburbs because we're building thousands and thousands of apartments in Melbourne. There's something like 8,000 apartments being built in the next couple of years in Melbourne. The blue represent the new towers that are being built and already approved in Melbourne. So we're going to have an oversupply of apartments. However, there are areas that will still do well. Be wary if you're buying apartments because you're priced out of townhouses and houses. Be wary of blacklisted suburbs by banks, meaning that you've got an automatic restriction on your loan to value ratios. In Victoria, Melbourne is blacklisted, the postcode 3000, 3004, World Trade Centre 3005, South Bank, South Yarra Docklands, and South Melbourne now blacklisted. So don't touch those suburbs for apartments. Townhouses and houses are fine, but not apartments. They don't work. You're going to get very low capital growth. You're going to have lending restrictions. Apartments work well in the following suburbs. You've got to have a 3-to-1 ratio between the price of a house and an apartment. So for example, in Toorak, the average two-bed is 672 and the median price is 3 million. So you've got a 3-to-1 ratio between the cost of a house and an apartment. So therefore, they're not competing against each other. That works. So you can see these are the top 10 suburbs in Melbourne where apartments actually work. So you've got Dippin St Kilda West, East Melbourne, Kew Glen Iris, Garden Vale, which is Bryden, Hawthorn East, Armidale, Middle Park. Where apartments don't work in Melbourne is in places like Mitcham. Great area, a lot of Mitcham, a lot of Maroondah Highway, green, fantastic. Apartments will never work in Mitcham. Why? $650 for a two-bedder, $850 for a house. How does that work? You're competing with houses. Why would you even rent an apartment? You can rent a house. So be careful with buying suburbs, apartments in suburbs where houses are comparable in price to an apartment. Now, as I said before, this is your special bonus section. That's about it for me for today in terms of my predictions and my little rant on what happened last year and how so many academics got things wrong. I believe the market is very strong in Melbourne. I think it's going to do well this year. But this is my bonus home study for you guys, just because you stayed tuned and watched this video for so long, and I went over time, which is also quite embarrassing. It's absolutely free. You can actually join me at a live event if you want. Tickets do sell out. There's only 40 seats available. And this is an amazing event where over 2 days we educate you on how to build and structure a large property portfolio from scratch. Now, the speakers at this event are some of the best speakers in Australia in real estate. We have Stephen Molnar, who's an investment property and finance strategist. He's been an educator for over 15 years, speaks internationally on Australian property, very good background. We've got an accountant that's very pro-property. And Martine Angelique is one of the best accountants that I've worked with, and she's a financial coach and a wealth creation specialist when it comes to property investing. Cameron Fisher from Changing Places Real Estate and director of buymyplace.com.au, which is now a publicly listed company. He's been in property for 30 years, 5,000 successful auctions in Melbourne, plus he's a valuer as well. So he's got a wealth of knowledge about what's happening in the Melbourne property market. I'll be talking about the psychology of investing and finance, and of course Stephen McClatchy from Loans Australia. Stephen has settled nearly $1 billion worth of investment loans over the last 20 years, and he specialises as a mortgage broker and a property portfolio strategist. Most of his clients are property investors. Some of them have 10, 15, up to 20, even 30 properties in their portfostio. So he's got a mortgage broking company that's very unique. So if you're interested in getting more information and more knowledge, simply go to realestateFasttrack.com.au, and tickets are free actually. So register your interest on that website. And when you attend, you also get a hard copy of my book, which is Australian Property Finance Made Simple, which came out a couple of years ago, and it's doing really well. So I hope to see you at the live event, and I hope to meet you in person check out the dates and the venue on the website. In terms of my book as well, if you are just interested in purchasing my book, jump onto bookonfinance.com.au. It's $32.95 and free delivery, or check out Amazon. I'm sure it's on Amazon for $10 by now, or eBay. And also, just going back to the home study, I've made this really simple to use, and I've made the back end really easy to access. So it's literally a bunch of videos and a manual, and you just point and click and watch the videos. So if you feel you've got value out of this video and you want to learn more, all you got to do is go to this link, or just scroll down below this video. There'll be a link to the home study. Click the link and you get instant access to 10 hours of education on real estate investing, plus a 265-page manual that you can follow those 10 hours worth of content online. And that's about it. And there's no strings attached with that, and I hope you enjoy the information. I hope you also register to my YouTube channel. I'll be releasing a lot more videos this year about different aspects of property investing. That's all from me, guys. You've been amazing. Thank you very much, and I'll see you on the inside.